I think one of the things is private practice versus group. Each comes with their own risk. Generally the credit for a group, when I say group, I mean 10 to 100 locations, is going to be a lot better. However, they could cut their losses. They're not as emotionally tied to it. Now, when you look at a private practice, which is individually owned, they're a lot more emotionally tied to it, but they could get hit by a car, or something, and then you're out of luck. So there's no right or wrong answer. We kind of are always, doing our due diligence on the groups, getting a feel for them, seeing how strong their financials are. It's just like with anything. When it comes to real estate investing, I think that I originally thought it was going to be passive income, all the way. And that's why I got into it. And then I realized oh no, this is very active income. So I think you just got to make a decision for yourself too. The only way to make it truly passive is by being a limited partner.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable, real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Hey, today I'm joined by Austin Hare, a former professional wakeboarder still competing, a Ninja Warrior national finalist, and managing partner of Leaders Real Estate. Austin is here to share his journey into real estate and strategies for creating stable, scalable investments. Let's go. Not working with the contractors who need to get paid daily so they can buy cigarettes. That's not going to be a good fit, right?
Well, truthfully, they're probably subbing out those guys. You're probably going to order the
DC. Then they're dealing with them.
But they're dealing with it. Yeah, they figured out how to deal with them. So
man, that's so stressful. Yeah, it's like elevating yourself to surround yourself with the right people, and then sometimes you actually inject yourself into bad situations based off the relationships that you're choosing to build. And how those, might be easier at the moment, but it's going to cause stress down the line. So much. I mean, that could be a whole podcast in of itself. But hey, as a former athlete, what lessons from your sports career have shaped your approach to real estate and entrepreneurship?
Yeah, there's a lot of overlap for sure. I mean, personally, I like to sauna and cold plunge in the morning.
Ooh, I love it too. Yeah, that's awesome.
So it's those were things that I kind of did to keep my body in shape, or I guess that I do now because we're still competing. But but it also helps with the discipline aspect of it. So it's when you get in a 43-degree tub, first thing in the morning, it definitely wakes you up. It gives you a little bit of a sense of accomplishment too, like a micro win, and it kind of gets you ready to go. So it helps both you on the physical side to recover, and then it helps on the mental side too to stay sharp. So I think that your body is how you eat actually really can affect your energy levels and everything in a business too. So from even if you're sitting at a computer and you're using your mind a lot, if you're eating junk food all day and you're not active, I don't know, for me, my energy levels drop. Working out actually gives me energy. So that's a direct correlation. But then there's also just the things that everybody talks about, the long-term gratification, the resilience that you build, just getting beat up, falling down, getting trying a trick over and over again on the wakeboard and not getting it is the same thing as getting told no over and over and over again. If you operate on a 30-day timeline versus a 10-year timeline, you're going to be disappointed. So it's I think trying to learn to enjoy the day-to-day processes more over the outcomes. So in wakeboarding, if you learn a new trick that I could, the goal is to put it in my run and to win the competition. But man, that was when I landed that thing in practice, that was the best feeling ever. So I try to, I'm not good at it really, but I try to just enjoy the process. Okay,
did I good at it?
Yeah. Right. Celebrate. Did I do a podcast today? Okay, that's a win. Did I close a new deal? No, but this is hopefully going to spur some momentum somewhere along the way, right? It's did I make a phone call today? Did I have a good call with an investor or a client? And maybe we didn't close them today, but we had the phone call, right? I did the act of reaching out to them, and it's let's celebrate that process. As long as I'm doing that every day, even though I'm not gonna be closing a deal every single day, maybe one day, but being able to be this is, I can tell that I'm on the right track, and just celebrating that micro win.
That's awesome. So long-term and appreciating the process, and keeping the perspective on the long term as well too.
Yeah,
So that way,
it's like that. Enjoy the journey, not the destination.
yeah,
It's just a different way, but that's so cliche that it doesn't mean anything anymore. So it's just kind of like a different way for me to think about it that helps.
yeah. With all of these assets in place, I mean, I'm sure there's a couple of different machines here with investors and assets, right? There's two different acquisitions basically that you're doing and managing. What types of systems do you use specific to the asset management side? Like what type of platforms allow you to say, hey, this is this asset, this is the tenant, and this is the returns, this is what we're expecting? How do you keep all of that straight?
Yeah, historically it's been mostly me on the short-term rental side and the wedding venues, but on the commercial real estate side, yeah, we actually use a platform called Appfolio, and so that just tracks everything there. So, our we have an in-house kind of CPA, and we will track the amount of money invested and then the distributions over time, and then we'll manually update the valuation so you can kind of track your return. But it's called Appfolio, and that's just a platform that we use to keep everything up to date.
And do you run anything off of that, or everything is done inside of the program itself?
But like, what do you mean run off of it?
Integrations,
No, I mean like
exporting data into other stuff.
Yeah, we don't. Yeah, we haven't done that. We've simply used it just for the investor portals so far.
Nice, very cool. So some general advice here for the listeners. If they're just beginning to explore real estate, what advice do you have to give them for evaluating opportunities in medical retail or other niches?
So, you got to kind of ask yourself, I think one of the things is private practice versus group. Each comes with their own risk. Generally the credit for a group, when I say group, I mean 10 to 100 locations, is going to be a lot better. However, they could cut their losses. They're not as emotionally tied to it. Now, when you look at a private practice, which is individually owned, they're a lot more emotionally tied to it, but they could get hit by a car, or something, and then you're out of luck. So there's no like right or wrong answer. We kind of are always, doing our due diligence on the groups, getting a feel for them, seeing how strong their financials are. It's just like with anything. When it comes to real estate investing, I think that I originally thought it was going to be passive income, like all the way. And that's why I got into it. And then I realized oh no, this is very active income. So I think you just got to make a decision for yourself too. Like the only way to make it truly passive is by being a limited partner. And that's when you're just saying like, oh, hey, this is a group that I want to invest in. I trust these guys. They have a good track record. They're going to go out and execute. And then I can literally just sit back and collect. And so there's certain we obviously are the GP for healthcare groups, but I've been the LP in other groups, like other retail developments and investments that we've done because it was outside of my core competency. So, you just kind of have to ask yourself, like, what is your time worth? What are you doing? Like, what are you doing with your time right now? Is it worth it to kind of jump in the driver's seat because it's going to come at an opportunity cost to whatever it is that you're doing or not? And I think a lot of times the answer is yes. And sometimes the answer is no. So, particularly when it comes to doctors and physicians and stuff like that, a lot of times they do want to get out of what they're doing, or they might have a timeline for doing that, right? Like they're going to operate chairside or practice for like another 3, 4, 5, 10 years. And then they kind of want to pivot into real estate. So it kind of just depends on your timeline. But I think like really my message would be understand the trade-off, like understand like the amount of time that it just takes to like originate deals and go through and do due diligence and syndicate these types of investments. And then, but the other thing would just be, if you're going through those steps and you say, hey, yeah, I want to do this, and I vetted these tenants. Next step would be, you can vet banks the same way. You can go and get multiple quotes from banks, like to try and drive those interest rates down because interest rates are really high right now. So, make the banks work against each other to give you a good loan, or if they want too much money down, again, it's kind of just all dependent on the, debt service coverage ratio, also known as the DSCR. So there's not a lot of flexibility there, but you might, you never know. So I would say like those 3 things would be my top advice.
And you got a podcast too. It's called Helping Healthcare Scale. Helping Healthcare Scale. Yeah. It highlights importance of growth and diversification. What are some key strategies for physicians to scale their investments while minimizing risk?
Yeah, so we've been really lucky kind of with the generosity of like prominent people in some of the different industries that come. Like we had the second biggest dermatology group founder and CEO on. We had the third or fourth biggest, dental support organization. The CEO came on the show, and then we've done 200 episodes at this time, so it's been kind of crazy, all of the stuff that we've learned. But in terms of like mitigating risk, I guess there's a couple things. So we do see people that want to own the real estate at all costs, and they will choose bad locations in order that they own the real estate. And we always encourage people, hey, focus on your business first and then like own the real estate second. If you want to own the real estate, that's fine, but like you're going to grow a lot slower, right? And we see people that want to grow fast and own all the real estate. And it's just like, you're not going to always find good locations that are available to buy, because if it's a great location, the landlord probably wants to keep it, right? So, that's, I think, maybe a way to reduce risk is to maybe focus on one or the other, not necessarily buy the real estate. And then, getting over levered. Like, we see these people, if you're growing, especially like in our niche, which is mergers and acquisitions and de novos and multi-site groups, you can grow too quickly by the same token. So you take on, a lot of debt and you're doing this arbitrage. There was the IBG, YBG, I be gone, you'll be gone. And so we saw groups kind of get their butts handed to them when they bought a bunch of practices. They bought them at a 6x, and then they knew that they were trading for an 8 to 10x. So they were just playing the arbitrage game. When I say 6x multiple of EBITDA, and that worked if you got out by 2022. But if you got stuck in after that, then all of a sudden, like if you couldn't sell, a lot of less groups were buying, and a lot of them were not paying those increased multiples. And then you had a lot of debt service that you had to cover, and the interest rates, more than doubled. So like some of them went out of covenants with their banks, and had to get. And a lot of investors lost their money, and a lot of doctors who rolled their equity, or practice owners who rolled their equity, lost their money. So it's not something that people talk about a lot because they're kind of able to change hands behind the scenes. But yeah, it's like, I think like maybe the way to risk off there is focus on being an operator over a consolidator. So what is your value add going to be? If you're acquiring other practices, are you doing it just to stack EBITDA, or do you actually have something in place to like, do you actually know how to increase the value? Do you know how to lower the operational costs? Do you know how to increase the same store growth? Is there something that you're going to add? PDS is like the third largest dental group, and they now refer to themselves as a technology company because they bring in a lot of technology and automation into their platforms that drive growth, drive top line revenue, and lower costs at the same time.
Driving up that multiple.
Yeah.
So a couple of things, you just dropped a ton of information there. I appreciate that. So I just want to come back through and step on a few of these things that we hear a lot and people may not always understand. So EBITDA, just very simply, what is EBITDA?
It's, earnings before interest, taxes, depreciation, and appreciation. Well, in short, it's like your profit margins. It's like when you go to sell a business, right? Like it's not quite your profit margins, like it's not quite your cash flow, but because they pull out some stuff on there, but like it's essentially like the earnings, right? It's like it's technically the closest synonym would just be earnings. So whatever your earnings are, then it's a way to calculate what your practice is worth. So like a lot of times we see 20% margins, and so if you're trading at a 5 multiple, like a 5x of your EBITDA, you're actually at 100% of your revenue. So I don't know, it's kind of like a interesting way to think about it. But usually, we see private practices trading for anywhere between 4 to 7 times their multiple. And then when you kind of start to add them together, get multiple practices, then you can start to go between that, 7 to 9 range. I've seen them go for 13, 14, 17x,
wow.
Back in 2022. But that's pulled back a lot since then and kind of stabilized closer to the 10 if you're doing a lot of practices together.
And the idea of the consolidation or compiling these together is the ability then to decrease the expenses while increasing the income, and that's going to raise your multiple through that process. But I liked your suggestion on keeping the one thing, being an operator as opposed to a consolidator kind of thing, because that's a whole different thing. You mentioned roll their equity. What do you mean by that?
Yeah. So if you are a private practice that's looking to join, a group, there's oftentimes an option. They'll say, let's use round numbers, let's say they want to buy your practice for $1 million, just hypothetically. They might pay you $500,000, and then you might take that $500,000 and roll it into equity in the company. And so what they say is like, look, right now our company is valuated at XYZ. that's going to be this multiple, call it, $5 million. And then it's like, but by the time we acquire all these other practices, like your 500 could actually turn into 1 million, or 800,000 or 1.5 million or something like that. So they actually, instead of they take some chips off the table, but they keep some invested in either their individual location or the parent company. But what happened was the guys that grew too fast, they got out over their skis. They took on too much leverage. They were consolidators, not operators. So meaning like they weren't going in and doing anything to these stores like at all that added any value. They're just stacking them all together like incoherent systems and revenue management systems and different cultures and all this kind of stuff. Some of them exited in time, but the ones that didn't, like everybody who had equity in it, it just got wiped out. So their debt service became too high. It was unmanageable. They overpaid for these practices and they couldn't make their debt payments. And so then an investor simply would come in, or somebody would come in and take it over for the cost of their debt, or the bank would take it over for the cost of their debt because they were out of covenants. So yeah, that's what I mean by operator
Rolling
versus
the equity.
consolidator.
Yeah.
Or sorry, yeah, that's what I mean by rolling the equity. Yeah.
Yep. And then you mentioned over leveraged. If you could just take a general shot at what does that mean to you? Like if I have these things that I consider good debt, which where I am playing the arbitrage, where the rent is more than the expenses and the mortgage payment and stuff like that. When you say over leveraged, does that make me have to consider the what if scenario if there was no income? Or is like what does it mean to be over leveraged?
No, I don't think it's in terms of the no income. Like in this particular situation, they depended on the multiples that they were paying. And so when private practices are trading for a 7x and you're trying to outcompete them and you're willing to pay a 10x for a private practice, you're going to have to take on debt to do that. And then that's over levered because now by that definition, it would take 10 years to pay off the amount of debt that you just borrowed to make your to make your ROI complete, right? Mm-hmm. So it's like if you're overpaying and you're taking on debt to do that, then that's how you get over levered. So it really kind of depends on the amount that you're willing to pay for the asset a lot of times. So in real estate, like if you're looking at something that's a 5% cap rate and interest rates are 7%, and you're trying to borrow more than like 65 or 70% of the value of the building, and you have negative monthly payments, then that you would be over levered, right? So it's like it's about on the front end making sure that you're buying these assets smart, like you're not overpaying for them, because then look, it's always a risk. There's always a risk in business, right? Like taking on any sort of leverage is a risk, but like in our world, we're okay with it. It's calculated risk because the returns just don't really when you buy real estate in all cash, like the returns just don't really make sense to justify that. And it's traditionally a safe enough asset that you don't have to worry about losing, that amount, but it goes back to buying it correctly. So as long as you're buying these things, as an example, if you're buying something at an 8% cap rate and interest rates are 7, then you're probably pretty safe in that situation.
Yeah. Buying for cash flow too is a good way to mitigate the risk of being over levered. Yeah,
it's unlikely that the bank is going to loan to you anyways if you're really over levered. So it's a little bit harder.
1.2 DSCR for basic looking. Hey, the last acronym that you threw out there was Genovo, and you mentioned it a couple times, and I think it was related to the startup type stuff. But what does that acronym stand for exactly?
It's actually Latin. It means of nothing or from nothing. So instead of doing an acquisition, you're just doing a startup location. But it's not really, the reason you don't use the word startup is because you think of like somebody with no financials, like a tech idea somewhere, but it's just a new ground up location of an existing bigger group.
Nice. So you've got the podcast. You've got, obviously, you've probably just dumped so much information on us that most of the listeners can tell, hey, you got some experience in what you're doing. So if this was a Ninja Warrior course, man, you're all over it and you're on to the championship for sure.
Thank you.
So you've got the podcast, and what's the name of the podcast again?
Helping Healthcare Scale.
And how else can the listeners get in touch with you to learn more about this? And man, you got so much experience to share with them as well too.
Yeah, man. LinkedIn, trying to be more active on there. So it's just Austin like the city, hair like on your head. But yeah, send me a connection request and drop me a line on there. Would love to connect.
That's awesome. So the listeners can find you there. What's next? I mean, what's 5-year plan for Austin?
Yeah, I think that I like real estate. And so, like I said earlier, I really look at these risk adjusted returns. So I think I'm like always kind of hunting for deals because obviously, short term rentals is different than healthcare. But I like kind of, underwriting these deals and looking at the risk versus the reward and trying to find, okay, where are these like really good deals that are going to preserve the capital, but also while giving a substantial upside? Because, I think the sweet spot is between like 15 and 19%. I think as you get up to above 20% IRR, look, that's great if you can get it, but there inherently comes a little bit more risk with that. And then by the same token, if you're down at like the 10, 11 ROI, or IRR, it's, I don't know, it's just a little bit low in terms of you could be buying the S&P and get a 9% return, right? Annualized. So, I think that like I'm going to continue to just invest in real estate and look for deals and try and find the asset or the deals that have outsized returns.
Nice. Well, it's been an incredible conversation. It's a pleasure to meet you. So exciting. And we just enjoyed the time here. So thanks again for coming.
Yeah, thanks so much for having me.
Big shout out to Austin again for sharing his expertise in the episode today. Hopefully you can tell he is just a wealth of knowledge with years and years and years of experience. Key takeaway, some notes from today. Healthcare real estate offers stability and risk-adjusted returns, and it can be really close to what you're doing currently in your profession too. Tenant quality is key. Focus on financially stable healthcare groups. He said those groups are going to have a higher credit rating too. Developing real estate requires patience, partnerships, and calculated risks. To learn more about Austin and his work, check out his podcast, Helping Healthcare Scale, and connect with him on LinkedIn today.